It's a bit early to go back into the markets according to our modeling and evaluation. I guess there are three pillars of good risk asset returns. They would be, of course, earnings growth, and then you would look for stability or falling discount rates, and you would look for at least stable or more adequate global liquidity. And those three, key factors look to be missing at present. And even more, I guess, disconcerting is that the outlook for the next 3 months doesn't look to be that much better. We're actually going to get some changes in the global economy and the global environment for risk assets, but they are really on the negative rather than the positive side. So it's early to call a bottom. It's early to go into fixed income instruments. It's still early to pick up most pro-cyclical or growth-dependent equities, and it's probably early to diversify out of the dollar, according to all the modeling we've been using this year.
John, can I ask you about the UK specifically, because a lot of news flow crossing the last 20-25 minutes or so from the Bank of England, and its inflation-linked bond purchase clearly dominant here, but we're still talking about a time-limited window, and it feels that the market is stressing about what happens after October 14 as they waited out for not the mini budget, but the Halloween budget.
The UK is pretty much, believe it or not, in line with most of continental Europe. It's had a bigger jump, about 350 basis points in its short-term interest rates than Europe, which has had about 250, equivalent to the U.S. So there's been more stress in the UK than in Europe on the short end of the yield curve. But inflation's about the same, about 10%. Growth is it's roughly equivalent. GDP growth has been about 4% year on year. There's not a major difference between Europe and the UK. There are specific problems in the UK when we look at we tend to run mathematical analysis of all the countries in the world, and of course the UK is one of the bigger ones, and it is important to finance, and it's not showing a particularly good outlook over the next 3 months for the UK. Big problems coming in housing, it looks like. Of course, consumer confidence and consumption looks to be under stress, and the external trade, although supported by the much weaker pound, itself is more of a revaluation of the value in external trade from the lower pound than a jump in volumes.